Welcome to Cafe Mutual YouTube channel. Friends, gold and silver have performed better than other asset classes like equity and debt over the past 1 year. So, will this rally sustain going forward? To answer this pertinent question, today we have with us Vikram Dhawan, Fund Manager Commodities at Nippon India Mutual Fund. Vikram has over 28 years of experience in commodities, markets, and fund management. So, let's welcome Vikram. Vikram, good evening.
Good evening, and thank you very much for inviting me on your show.
Great. So Vikram, my first question to you is that what is your medium-term outlook on commodities like gold and silver?
So I'll start with gold. So gold is now on a slightly different pedestal um, post the de-dollarization, which we thought will take a lot of time, but actually it is happening in earnest, and a lot of countries are actually looking at substitutes to dollars. I mean, obviously, I'm not saying that it's going to happen overnight across the world because the West would still resist it. But if you look at what's happening in the East, especially Asia, China, Russia, and to a large extent, we are also trying to, as a country, trying to, sort of maximize the penetration of rupee beyond our borders. So the de-dollarization actually has begun. Now, how long it takes to sort of really, diminish the dominance of dollar, that remains to be seen. But I think the sentiment is there. What it does is it puts the non-dollar currencies in spotlight. And gold is one of the oldest currencies that mankind has known, and it is actually, you can say, uh, one of the most sound currencies, if you would like, because so far central banks have not found a way of printing gold. I mean, they have figured out a way of printing money, but not gold.
Right.
So that keeps gold in a very higher pedestal right now than the past rallies. And also, I think, at the end of the day, if you look at the liquidity of gold vis-a-vis the liquidity of so many other currencies, leaving besides the US dollar or maybe euro or yen, I think most of the currencies, Asian currencies and North European currencies or African currencies, don't even have the fraction of the liquidity that gold market has. So it is the liquidity also, and obviously central banks are large investors and holders, and I won't like to use the word traders, but yes, they keep on buying and selling gold on their behalf, as the case may be. So that's, I think, gold has become very strategic, and I think the focus will not purely be on returns. It will also be whether what strategic hedge you have got in your portfolio if the world order we know starts changing. And also, I think gold has done pretty well in the past 2 years, last 2 financial years. And still, YTD also, it is one of the best performing asset classes. And I think going ahead, there'll be a lot of strategic demand for gold, which means that whilst nothing is exempt from volatility, even dollar also, even besides the dominance, dollar has had, bear markets and bull markets. Gold will also have those. But I think there will be the subscription and the interest from the investors, from the countries and the central banks will be a lot higher than what we have seen in the past. With regards to silver, I think what works with silver is it's actually very highly correlated with gold. Second thing which works for silver is that roughly 55% of the silver is consumed for industrial uses, as against gold, which is almost entirely used for jewelry or investments. Very small amount, 2, 3, or 5% of gold, or even less than that, gold goes into industrial uses. Silver is a lot more, but the good thing is that the new demand for silver is coming from new age green tech industries like electric vehicles, EVs, 5G, solar, which have a higher tolerance for higher prices for long. Because unlike the conventional traditional industries, which are very cost conscious, where the demand, goes down if the prices spike up. But these industries still have at least few more years, if not a decade or so, where they will still be in startup mode, and the priority will be more to build capacity, in which the stakeholders will be able to tolerate much higher prices than they have been in the past. So yeah, it's looking very positive for gold and silver from here. But having said that, everything is also a function of global liquidity and risk assets, volatility, and if these two things were to spike up, then the effect will also spill over on gold. So positive, but the caution of a few months ahead.
So both, Vikram, both gold and silver have delivered 20% return in the last 1 year. So what has contributed to this performance, and how long will it sustain?
So when you talk about gold, there are four pillars of the price action. One is obviously the physical demand, the jewelry demand. Roughly 50% of the global jewelry demand is accounted for by China and India. And as you have seen, that we had record imports and consumption of both gold and silver last financial year, almost close to all-time high in terms of value. And definitely in terms of value, all-time high. In tonnage, also very close to all-time high. China also, despite the pandemic, the demand has been pretty steady. So then you had the central banks buying, which was last year at a 50-year high. I mean, the last time the central banks bought this much amount of gold was in the 70s. And just to give you an idea, total figure as per the World Gold Council was close to about 1,300-1,400 tons, which is roughly about 30-35% of the total global demand. So you can imagine that they were actually the elephant in the room as far as gold buying was concerned. And the reason why gold prices were not even higher was because there was a lot of selling by the global investors, because we have been post-pandemic, we have been in mostly a risk on mode, where people have actually believed in buying risk assets at dips. That led to a lot of money coming out of safe havens. And also there was a lot of volatility in the international risk market, especially US and Europe last year. And a lot of portfolios were sort of under pressure. And typically what happens is that when you cannot sell your equities and bonds in very high volatility, then the only thing you want to sell is gold. It's even whether it's a company or a country or a house, when you can't raise money from anything, you sell the gold and silver to raise money. So a lot of that was also into play. And obviously, the fourth pillar is the event risk. So it was inflation. Earlier to that, it was COVID, and it was inflation. And now I think we are staring at a risk of a US debt default. So all of this, added to the rally in gold. Silver followed because silver has been, undervalued with respect to gold. I mean, gold-silver ratio historically typically is between 40 and 80. During the COVID and post-COVID, it went to as high as 120. Even now also, we are at about close to 85. So on historical basis, silver is still relatively cheaper compared to gold. We're living in very strange times, and we don't know what is debt default the only event that we have to worry about, or there's something else on the horizon. So all these five factors which I mentioned, especially in case of silver, the demand from the new tech industries is putting a very strong floor under the prices.
So Vikram, while gold ETFs have been around for over 15 years now, so they are yet to make a meaningful mark. So what are the key reasons for this?
So I think, first of all, the India, as I mentioned, the Indian market still remains, by and large, the physical market. But I think what you need to appreciate is that, today, the whatever gold ETF, penetration that you have seen, it's mostly come from investors who are, capital market savvy, or who are comfortable with capital markets, which you obviously are aware is a very small percentage of the total population. So far, the target audience has been quite limited, if I would like to say. I mean, there are various figures being sort of touted, whether that only 2% people have demat account or 5% people. So best case scenario, that is the target audience today is excluding 90% of the Indian population. So if you consider that, it's done extremely well in terms of AUM and in terms of penetration and understanding of the market. And silver even more, because as I mentioned, the learning curve for the market and the investors was a lot shorter than what we saw in gold. But I think as there is more penetration of mutual funds, as we get more folios from, the traditional capital markets investors, and people realize the benefits, safety, and convenience of gold ETFs and silver ETFs, I think this is going to pick up, very strongly. But yeah, the fact of the matter is that it is quite lamentable that today the total combined AUM of gold and silver is not even 1 or 2% of the global AUMs. So which I think, despite we being consuming roughly 1/5 of the gold and silver, so I think there's a huge gap, which is a good thing, So I would like to say, as they say, the downside is limited from here as far as the acceptance of this product is concerned.
Vikram, how can MFDs make gold and silver more acceptable among Indian retail investors?
So I think, Nishant, I was quite, every time I speak to a set of investors, or every time I speak to even my, acquaintances also, I'm quite surprised as the limited knowledge everyone has on these products. I mean, to give you an example, I mean, not many people know that gold ETF and obviously subsequently silver ETF are actually the best invention of the financial markets of this century. Why? Because you can trade very small amount of gold, a gram or even a less gram of gold through ETFs, with a liquidity which is significantly better than the underlying physical market. I mean, for that kind of liquidity, you would have to trade hundreds and kgs and tons of gold in physical market to get that kind of liquidity. Whereas for the retail investor or for investor of any size, the moment they start trading gold ETFs or silver ETFs, they're able to get similar liquidity for a very small ticket size. So that is one thing which people don't, that is some that we as a fund house and through medium like yours, we try to educate investors on the benefits of that. Secondly, the safety part. Gold, whilst is a very safe asset, but any money, whether it is my money or I've inherited, somebody has worked hard for it, so it needs to be safe. And we all know that mutual funds, thanks to the mandate of SEBI as a regulator, are arguably the safest mode of investments in the capital markets today. So it is convenience, it is less impact cost, it is safety. And last but not the least, I think what the investors also need to appreciate that there's a very clear mandate by the regulator SEBI that all ETFs, whether it is gold ETF or silver ETF, they have to be backed by physical gold of very high quality bars conforming to the best international standards, which is the LBMA or the London Bullion Market Association, good delivery bars. So, you're getting quality, you're getting liquidity, you're getting safety. So there are so many things that you're getting in this product. And I think this is something which I'm surprised whenever I go beyond the metros or speak to people who are not so much clued on the capital markets, and they're surprised when we tell them about these things. So I think it will catch up. There is a process, and unfortunately, in a lighter way, that equity and bond markets are Bollywood, and we are the art movie. So nobody writes about us as much as they write about them. So I think it will happen. It will catch up.
So Vikram, there are many gold and silver ETFs in the markets currently. In such a scenario, how should MFDs shortlist good gold and silver ETFs for their clients?
Yeah, sure. So I think any ETF, whether it is commodity ETF or equity ETF or debt ETF, the biggest thing is the liquidity, because the whole purpose of ETF is to have less impact cost. And there's no point buying an illiquid ETF of any asset class, because then you might as well buy the underlying instead of the ETF. So liquidity is of paramount importance. What the size does to the fund is that it has to be at least of some optimal size, because it should be able to take large inflows and outflows without too much of distortion of the NAVs. Sorry, you have to also see the capabilities of the fund house in terms of experience and in terms of what they bring to the table in terms of the expertise and the capabilities.
So how are Nippon India Gold Bees ETF and Nippon India Silver ETF different from other such funds in the markets?
So obviously, I think it's tough to share these numbers of size and liquidity, because we can't, as far as the regulatory restrictions are concerned. But I think I would leave it to your investors to sort of grade every ETF on the parameter as suggested, and then make their own choice. But yes, whether it is our ETF or anybody else's ETF, it will be graded on these parameters only, and you have to tick the right, all the boxes before it becomes a product which delivers, what the investors expect it to deliver.
Okay. So Vikram, one last question. What are the financial goals that can be linked to gold and silver ETFs, and what is the ideal holding period according to you?
So I think, as I mentioned, that from the portfolio point of view, again, this is something which is my personal view, and it also stems from a study which was done by World Gold Council a few years back, in which they mentioned that for an Indian pension portfolio, allocations to gold less than 5% and more than 15% are suboptimal for the performance of the portfolio. So I think they give a range of 5 to 15%. It's not cast in stone, but yeah, they did the analysis, and which makes a bit of sense. Now, in terms of the investment goals or the portfolio goals, as I mentioned earlier, the gold prices have got a very strong negative correlation with the fixed income market, and very poor to slightly negative correlation with the equity markets. Now, obviously, on a longer term basis, how gold helps the portfolio or silver helps the portfolio is like this. Compounding is a very important aspect of every portfolio, and you don't want your portfolio to be in such a situation where it's way up in positive in 1 year and it's way negative, next year, because in mathematically, a 10% rally is not quite the same as 10% fall, because they could be from different levels. So you need at least some part of your portfolio which is steady, which gives you steady compounding. And what gold does is, if you put it in a multi-asset sort of a portfolio, it absorbs the shock of debt and equity because of its negative correlations, and it sort of gives you a lot steadier compounding and a lot steadier portfolio in the longer run.
With that, we have come to an end to this interesting session. Thank you so much, Vikram, for your valuable time and inputs.
Thank you very much for inviting.
And finally, I thank each one of you for being such a wonderful audience. Have a great day, guys. Bye.